Here's the hard truth. Your employer is not your family or friend. Rather, it purchases your time and knowledge and expects to receive more value from your work than it pays you. A company may call its employees a family and celebrate service anniversaries and an occasional pizza lunch. But the moment eliminating you improves financial forecasts, the family relationship ends in a 15-minute HR meeting. Your building access is disabled, your email is locked, and your duties are handed off to people you trained. Your loyalty becomes a cardboard box of photographs and coffee mugs. That's it. Thank you. Goodbye. Welcome back to Wealth Horizons, where we discuss practical ways to protect our money, health, and independence throughout retirement. Today, we are dismantling 4 myths about workplace loyalty and then discuss 7 steps of how to organize your money, benefits, and career so that losing a job doesn't destroy your retirement. Losing a job in your 50s or 60s can trigger a chain reaction of unemployment, lost health coverage, early retirement account withdrawals, and an early Social Security claim that permanently reduces your monthly income. You must prepare now while the company is still telling you how valuable you are. Myth number 1. Decades of loyalty will protect me. You arrive early, work late, and manage to survive reorganizations, mergers, and management changes. You train new employees and preserve institutional knowledge that exists nowhere in the company, and after 15 or 20 years, you assume your sacrifice has earned some degree of security. Wrong. You earn a larger salary, receive more vacation time, and use more health benefits than a younger employee. Management may conclude that you can be replaced by 2 juniors, or a contractor, or these days, by AI. Your responsibilities slowly disappear. You stop being invited to meetings, your projects are reassigned, and performance standards change. Institutional knowledge is valuable, but perhaps less than reducing payroll. Myth number 2. Hard work will eventually be rewarded. The hard workers are given the work everyone avoids, and if someone quits, the hard worker temporarily absorbs the responsibilities, and the company discovers that one person can perform both jobs for one salary. When a promotion comes up, the bosses say, "We can't afford to lose you in your current position." So, someone else who networks well gets the promotion, a larger salary, and credit for your work. It's important that you keep a private record of your accomplishments, revenue generated, expenses reduced, projects completed, and responsibilities added. When the job expands, request a formal review of compensation and title. Don't accept endless promises that your sacrifices will be recognized when the budget improves. Promises don't pay your bills. Myth number 3. Staying loyal will keep my salary competitive. A loyal employee stays for years and receives modest raises based on an outdated salary, while a new employee arrives with a higher starting salary because the company must compete in the open market. Sometimes you need to leave the company, establish a higher market elsewhere, and return 2 to 3 years later to get a competitive salary. The financial lesson is that your employer will rarely volunteer to maximize your lifetime earnings. So, at least once a year, compare your compensation with current opportunities. Loyalty without market information is financial blindness. Myth number 4. We are a family means the company cares about me. A real family relationship is not terminated because a quarterly earnings report disappoints investors. The corporate family language often appears when management wants employees to provide something outside the employment agreement, e.g., stay late because the team needs you, answer messages during vacation because everyone must pull together, etc. The company expects employees to behave like family while reserving the right to treat them like expenses. You should not become hostile or unprofessional. Rather, you should recognize the relationship for what it is. You should perform excellent work, honor your commitments, and treat people properly, but never confuse professional cooperation with unconditional loyalty. Always be prepared. Here are 7 steps of critical preparation. Step 1. Build a job loss reserve. A conventional emergency fund may not be enough for someone approaching retirement. A younger worker may replace a job relatively quickly. An older, highly compensated employee may face a longer search, accept a lower salary, or never find an equivalent position. Calculate the minimum monthly amount required to protect your housing, utilities, food, insurance, and debt payments. Then, build a reserve appropriate to the time it could realistically take to replace your income. This money buys negotiating power, and without it, you may be forced to accept the first offer, or raid a retirement account, or claim Social Security earlier than planned. Step 2. Control your fixed expenses. A large salary can conceal a fragile financial structure. The danger appears when a household has built every obligation around the assumption that the highest paycheck will continue indefinitely. Avoid reaching your final working years with an oversized mortgage, expensive vehicle payments, revolving debt, and financial responsibility for several adult relatives. Your objective is to make employment optional before the company makes it unavailable. Every permanent expense you eliminate reduces the amount of control an employer has over you. Step 3. Know your benefits before the exit meeting. Do not wait until termination to investigate your retirement plan, pension, stock awards, unused leave, health insurance, or severance policy. Know which benefits are vested. Know which benefits disappear when employment ends. Know the deadlines for exercising stock options or making health coverage elections. Download plan documents and personal records while you still have authorized access, but never download restricted, confidential company information. Keep current contact information for the retirement plan administrator, insurance provider, and human resources, such as full names, direct emails, and direct telephone numbers. After termination, you will lose access to the employee portal immediately. Step 4. Build a health insurance bridge. For someone who loses employment before Medicare eligibility, health insurance through COBRA is very expensive. Check into an Affordable Care Act marketplace plan such as Ambetter. Also check out Cost Plus Drugs, a direct-to-consumer online pharmacy that can lower your prescription costs as it has a 15% markup over cost, a $5 pharmacy fee, and a $5 shipping fee for home delivery. Plus, you can get 90-day supplies. If you are already eligible for Medicare, understand how the loss of employer coverage affects enrollment deadlines. Talk now to a live Medicare expert. A health emergency should not transform a layoff into bankruptcy. Step 5. Keep your market value portable. Your skill, reputation, and professional relationships belong to you. Keep your resume current, maintain professional licenses, stay in contact with people outside your employer, and understand the technology affecting your occupation. Consider creating a LinkedIn profile, connect with peers, and earn some credentials and certificates on LinkedIn Learning, Coursera, EDX, or Udemy. Step 6. Develop income the company does not control. A side business, consulting work, rental income, investment income, or another legitimate revenue source can reduce dependence upon a single employer. The goal is not to replace your salary, but rather preventing an HR decision from reducing your income to zero. Make sure to keep side activity separate from employer time, equipment, and information, and keep it to yourself. Talk to a lawyer and consider creating an LLC for your side business and get an EIN from the IRS to evidence its separate nature. Step 7. Stop financing the appearance of success. Don't count on raises or increase your lifestyle when compensation increases, but rather direct every raise and bonus toward debt reduction, retirement savings, and the job loss reserve. A highly paid employee living from paycheck to paycheck is not financially secure. The true reward for higher income is not a more impressive lifestyle, rather it is the ability to walk away. The Employment Independence Test. Ask yourself this question. If my employer eliminated my position tomorrow, how long could I maintain my household without using credit cards, raiding retirement accounts, or claiming Social Security? If the answer frightens you, do not respond with greater loyalty to the company. Rather respond with greater loyalty to your own financial security. The bottom line. Your employment may provide good compensation, valuable benefits, meaningful work, respect, and your co-workers may become genuine friends, but none of that changes the underlying financial relationship. Always maintain cash, control debt, understand your benefits, and protect your health. Keep your skills current, develop outside relationships and additional income, and never allow corporate praise to replace competitive compensation. Your employer is not your family. Your paycheck is not permanent. The safest time to prepare for losing your job is while everyone at work is telling you that you're indispensable. This video provides general educational information and is not financial, legal, tax, employment, or insurance advice. Employment agreements, benefit plans, insurance rules, and individual financial circumstances vary. Review important decisions with qualified professionals. If this video made you reconsider the price of workplace loyalty, please like the video, subscribe to Wealth Horizons, and share it with someone who still believes that 20 years of service guarantees another continued employment and paycheck.